Good morning, everybody. Hope you're all doing well and surviving after the night before. Lots of action going on. Good morning, K-Man. How are you feeling today?
Good morning, Ryan. Feeling pretty good. Whirlwind timing markets, it seems, right? Got a few surprises over the past 12 or 15 hours. Yeah, interesting times in the wonderful world of FX.
Yeah, very much so. And let's hope we don't get a drop in volatility once we're all over this hump, which I fear we may be looking
Yeah.
towards. But let's get through this first, and then we'll see what happens later. Right, obviously, lots and lots to talk about it. So I've been pretty selective with the headlines and speakers and whatnot. So we'll get through the main super nuts stuff today. Right, well, firstly, we'll start in Japan, where the Nikkei decided to drop a sources piece right bang in the middle of Fed Powell's speech. This was a piece citing sources saying that they're potentially looking at the next rate hike in July or October as they see the yen weakening. It's all a bit could do's, maybes, that sort of thing. If inflation does this, if the economy does that sort of thing. But it's the first we've really got on any sort of dates or future forward guidance being bandied around as to hikes. But as I said, that did come right bang in the middle of Powell as he spoke. Onto some other data or survey. There's a corporate survey saying 62% of firms see the BOJ raising the rate to 0.25% by the end of the year. Why is that important? It's important because 40% of firms then expect to front load investment, i.e. capital expenditure, ahead of Bank of Japan rate increases. So what there could be is a little bit of a rush to borrow money at the cheap rate before rates start going up and use that for their investment. Why is that important too? Well, it could mean we get a rush of economic activity before rate hikes step in. But conversely, once they happen, it means that if they've front run their activity, it can then peter out later on. All part and parcel of what happens during a hiking cycle. But yep, firms are looking to do that. On the data front, I'll see if it's on this calendar. We had the Japanese, let's see if it's in there. Don't know if it's in there. No, it's not. So we had the manufacturers index, firms manufacturing index survey, which rose to +10 from -1. That was a 3-month high. Non-manufacturers rose to 32 from 26, a 7-month high. So green shoots seemingly there as well. Manufacturing's been in a bit of a slump, as it has been in a lot of places around the globe. We did get their PMIs as well, which confirmed that a bit as well. A rise in manufacturing to 48.2 from 47.5, expected 47.2 previously. So some green shoots appearing there as well. Services improving as well, 54.9 from 52.9. So good improvement there. Things are seemingly going the right way. If inflation plays ball as well, that'll justify their hike, and we might be properly off on money. Ueda was in Parliament. A lot of his comments were a bit of a repeat of the BOJ meeting. But there was a couple of additional ones that he saw a risk, or they saw a risk for the need of rapid rates if they had waited too long to end negative rates. So they might have had to rush with hikes later on. So preliminary wage negotiation outcome tends to be revised down, but even so, we thought the final outcome would be a fairly strong number. Was talking about rolling off their balance sheet. Not too many comments. They still don't know really what and when and how they're going to do it. But it did say that the high level of JGB holdings continue to have an impact. But they are looking at what they're going to do with reducing the balance sheet. It will be coming at some point. as Japan was on holiday yesterday, they were all back today. Finance Minister Suzuki out with a jawboning. Says it's important for currencies to move in a stable manner, closely watching FX moves with a high sense of urgency, yada, yada, yada. Same old lines at the moment. He'll be pleased looking at the chart today that we're not through 152 at the least, but we're not out the woods just yet. Over in Australia, we had a gangbusters, blew the bloody doors off. Employment numbers from those guys, 116,000 for those numbers there. Unemployment rate falling to 3.7%. That's quite a significant drop there, even as the participation rate that came down a pip as well. But that's a big move there on that one. The full-time number 78k as well. So it's all jobs gains going in the right place as well. So gangbusters. I don't know. Was there any comments that you saw alongside that? Was there some sort of skew in there that we know of, Kay?
No, I haven't seen anything specific. Well, it may be, you know, there's always stuff going on around the turn of the year. I mean, there's some countries where it's like really specific, but I haven't really read up too much on it. To be honest, it's extremely strong, right? Because it's not, especially the full timers. That is a very, very good number. But it may be, you know, that something is seasonal there as well. I'm looking at it. The December number was a bit weak. January average, and then we get a really good number right now. So. Is it still a give back from December? Possible, but really, really strong number, and Aussie dollar reacted quite strongly on it as well, right?
Yeah, exactly. I mean, if you're just looking at this chart, it's not really significant, but the upside numbers are bigger than the downside numbers, so it shows that the jobs market is fairly resilient over there as well.
Yeah, and the frequency as well. Huh? You get like exactly. One bad one, and then it's followed by 2, 3 positive ones, right?
Yeah,
so,
exactly.
That I think is still quite good, actually.
Yeah, and that's perfect soft landing numbers for the RBA as well, who are not ready to commit to cuts just yet, which is probably sensible, because if wage pressures and the like come through as well, then they'll have to look at that on the inflation front. But anyway, good numbers now. Aussie dollar didn't need any encouragement. It was already heading that way on the back of a weaker US dollar. So it was just another tailwind for that. But we'll look at prices in a moment. Norges Bank left the rate unchanged as expected, but they do see the rate gradually moving down after autumn. So there, a bit of forward guidance for cuts there. The SMB and K-Man's going to do a well-deserved victory lap on this one. And as our guys in our room, they surprised with a 25 pip cut in rates this morning. Says they are prepared to intervene in currency markets if needed. That's the old line. Jordan said that uncertainty is still elevated and they will adjust the policy again if necessary. But then he shut the door on any speculation by saying we give no forward guidance on future interest rates. We will see where we are in 3 months' time, as he packed his bags and jumped in a taxi for his island holiday. Said we have no goal for the size of our balance sheet. We have no need to reduce it. So no QT talk going on over there. Kay, super nuts of the SMB.
Yeah, I mean, I've been talking about it so often, and also in the run-up to this SMB meeting that corporate Switzerland was putting quite a bit of pressure on the SMB as well, and we got what we in the room were looking for. Well, yeah, let me do a small victory lap on that one. We've been working on this. Excuse me. We've been working on this since the end of last year, right? When the Swiss was really strengthening, we were like trying to be very patient, and then actually at the end of the year, I entered quite a few decent positions, and people in our room as well, and this is our deserved reward, I think, for having been patient, for having seen the stuff coming after all. There was a lot to do about the FX reserves being at levels where I'm not saying it was unhealthy, but we were back to 2015, 2016 levels. And also inflation was coming down rapidly. We had a few average Swiss data on the side as well. Exporters weren't very happy. And here we are. So this is a response to whatever happened. He did a victory lap as well, saying that inflation is 0.5% lower from where the prior forecasts were. So that is what he already hinted at well, he didn't hint at the inflation, but he said that the work was kind of coming to an end when already in December, when the Swiss franc was still rising. And now, since they only have a meeting every 3 months, we had to wait for a long time. But here we go. Market wasn't pricing it in fully. I see that some part of the market was still a bit even long Swiss, but this is not the case in our room. We were really preparing for this. We got what we wanted. So yeah, I've had two pretty decent options running. I've taken the dollar Swiss leg off because it's a bit uncertain about the dollar, but I'm keeping the cross decent parts of the cross Swisses open. I still think there's a bit of more juice left in those Swiss pairs after perhaps a round of consolidation. People who were short Swiss probably taking a bit of money off the table as well. And now we are going. But Jordan is said that they could be both ways of the FX market, but for the time being they are not considering it. So he does not tell us, because that was one of the questions that I had going into this meeting. If they have a cut, then we still need to know what Jordan is going to tell us, because if he says, like, to the market, do not undo all the good work that we did towards inflation by sending the Swiss franc a lot lower. He did not really mention that too much today. So there's still a bit of a door open, I think, for a bit of further move on the Swiss franc globally. And in the meantime, the S&P hedge fund is probably behaving or doing a lot better as well, with the equity markets being where they are, skyrocketing, and they probably will make the money back that they lost on paper last year. So everything is rosy and dandy at the S&P, and the Swiss corporates will be happy as well.
Yeah, and gold as well, shooting up through 2200. All goes into the pot, all goes into the profit pot for them. But yeah, we spoke about it a few days ago. This is why we do the analysis we do on the Flow Show and in the chat room, because it doesn't mean every instant there's a trade, but you get moments like this where you see something happening in a country, in a market, in the price, and you strategize, you talk with others, you build a case, and you get a trade on. And you have to wait, you have to have some patience sometimes, but the hard work pays off. And that's the great thing about our community here. You're not there's no one person on their own. There was more than several people getting on these Swissy trades months ago in readiness for this, and all the boxes got ticked over time. And this is where you make the real good money. Okay, it's okay grabbing 20 pips here and there a day, but you get moves like this. This is where you grab the 5, 6, 7,000 pip trend moves. And long may it last for the guys, Kay and the guys who were in it. It's been a pleasure to watch. I love watching, as I said in the chat room, I love it when a plan comes together, and it's very good. So yeah, these things don't come along often, and you've got to maximize them when you do.
Yeah, this is one of the things that we talked about the theme, and I said that as well. Swiss, and I've done this interview on Trader Summit as well. If the people want to want to review it. This is one trade that I was like really preparing, and then we knew it could take months. We knew that the S&P is only meeting every quarter, but the Swiss franc really went too far, and the FX reserves too low. So we prepared it, and this is the fruit of 3 months of reflection and hard labor and the positioning. You need to be in the position to reap the fruits as well, right? So we
Yeah.
did, and that's no, today is a really, I must say, today is a good day. Good day at the office today.
Good day at the office. Yeah, certainly will. And you make sure you treat that missus of yours with some of those profits, mate.
Yeah. Whoa. I lucky you didn't hear that.
Yeah, you suddenly unplugged your speaker. Right, let's move it on quickly. ECB Snowball says we may now be facing a turning point in real interest rates. Quite an important comment because the road moving forward, and her speech was on what's called the R-star, which is the neutral rate of interest when things are all going swimmingly as well, short-term rates. This is where all central banks want to get to, this R-star neutral rate. So she was just talking about that. It will become a big feature once cut starts. Everyone's now guessing when cuts are coming and how many there's going to be. When all those start, it will be where's rates going to drop down to before stopping, and that's going to be very important for flows later on in the year and next year. ECB's Nagel, he's I don't know how to take these comments. His ECB is getting continuously closer to the 2% inflation target. Then he said this comment: he's more concerned about Europe being the sick man than Germany. He obviously wrote that before the PMI came out today, which showed manufacturing dropping to 41 point something. I'll get it up on the calendar. So, but he doesn't believe Germany is the sick man of Europe. He thinks that Europe itself will be the sick man. Crazy, but there you go. German manufacturing 41.6. This is the growth engine of Europe, folks. Although we did see services improve a tad as well. Right, while we're on the PMIs, let's go back to some of the other ones. New Zealand GDP was out, confirmed that they were in recession for the second half of the year, so not looking too good over there. Aussie had that good jobs report, but the PMIs were a bit mixed, a bit of that divergence between manufacturing and services. So manufacturing dropping a point to 46.8, services going up 0.4 of a point to 53.5. Where we going? Coming down to all this stuff. Oh, tons of stuff. Right, PMIs in France going backwards. Those green shoots looking like they're dying off a bit. Manufacturing down further into contraction. Services as well falling back again. So not looking too good in France. Just mentioned the German numbers, the Eurozone, pan-Eurozone numbers, just a reflection of what we've seen there, a little bit softer, although services ticked up a bit. The UK as well, services came down, but that's still a fairly strong number. That's not going to, no one's going to moan really about that. So it's been pretty strong. But manufacturing nearly hit the expansion mark. So those green shoots, as I said in the chat room, just grew a little bit taller in March. However, for the Bank of England, in the details, there was still a lot of inflationary pressures. There was a bit of easing in inflation pressures in input prices, but the amounts firms were charging to sell their goods was still very strong. So there's still a lot of pass-through going through inflation there. So that's going to be something for the BOE to consider. Bank of Canada, their summary of minutes, whatnot, after their meeting, saw no need to change QT, but they expect rate cut conditions to emerge this year. So we're going to be playing the cut game for the BOC soon as well. Over to the Fed. Here we go. Over to the Fed. Rates unchanged as expected. They kept in the line, and this was the big line, if you like, one of the big lines. They kept in a line that said the committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably towards 2%. That was the first pin in the balloon for a market that was leaning too hawkish going in. The vote was unanimous in favour of keeping the policy unchanged. So even the biggest doves weren't ready to hint at going against the status quo. They hiked their forecasts for GDP and PCE, not huge, but up nevertheless. And they lowered their unemployment forecast by a pip here and there. So it's another bullish move there. So bullish on GDP, hawkish on inflation, bullish on unemployment. So all reasons why you might think the Fed would delay cutting rates. The market didn't get its 2 cuts in the dots. The dots did move up. They moved up across the board by varying degrees. As we've been saying on the show, that was largely expected. And again, it puts a bit of a hawkish slant on things. But because the market didn't get its 2 cuts, it really threw its toys out the pram. Now, as always, there's different opinions over whether Powell was dovish or whatever. It all needs to be taken in context. He came out and said that the economy has made considerable progress. Inflation has eased substantially, but remains too high. They're committed to the inflation target, but the path forward is uncertain. They're likely to cut rates sometime this year, but are prepared to keep rates higher for longer if needed. There's a general sense that slowing the pace of the runoff will come fairly soon, and slowing the pace of the runoff will ensure a smooth transition. The projections do not mean a higher tolerance for inflation. So that was a little bit of a hawkish line. And taking Jan and Feb together has not changed the overall story. The significant weakening in the labour market could be a reason to begin rate cuts. Then he said, we tend to see a little bit stronger inflation in the first half of the year, but we are unsure if this is a bump on inflation on the inflation road or something more. So a little bit uncertain there over what we've seen from the CPI numbers over the last few months. He did also remark that inflation had been stuck for the last 9 months, which, as you know, is something I've been pointing out here as well. So he has acknowledged that it hasn't moved down at all. So on one hand, there was nothing dovish from him, in my opinion. It was a lot of we're in the same position as we were last month or last meeting and the meeting before, but it was all down to the market and where it was positioned. It was positioned far too hawkish, and as I say, it threw its toys out the pram and decided to spank the dollar, and we see where we are now. So the Fed is where they're at. The market is now going to have to readjust itself and what it thinks for cuts. I want to point out something I got wrong yesterday. In the midst of me talking about the market being overly hawkish, for some reason I was saying that the expectations for June cuts picking up to 75% from 50% was hawkish, which was actually complete bollocks. So I know Horatio kept trying to tell me about that, and I kept not seeing it. So I want to apologise if that confused people, but it's been a busy week. So anyway, that's my thought on the Fed. Just quickly before I turn it over to K-Man for his thoughts, take the simple approach, okay? We've spoken about this for the last few days. Friday or Thursday, we got the PPI, got the retail sales. That confirmed that the CPI, at least the PPI confirmed that the CPI numbers might be correct because they were higher. This was all Fed pricing. This was the market getting into that 2 cuts, getting a bit too hawkish, and look where we are now. Pretty much right back where we started, give or take. We've been up here and we're down a bit and whatever. But we've really washed it all out. So we're right back where we started, which is basically where the Fed was. The Fed have not changed the needle much on anything, in my opinion. And the market's had its little run around, and now we're back where we begin. Okay, your thoughts, mate?
What do you expect me to add? You said everything. You did a whole Powell press conference here, both sides of the line, like he used to do. No, spot on. Market expecting too much again, and the pendulum swings. And there was, to me, okay, the dots they moved a little bit less than wild expectations, and there was something about QT where I actually decided to pull the trigger on. I was trading off a bit of a Aussie dollar short, and I pulled the trigger then when he said like it may be coming soon. It was a bit vague. He's been very vague about this. About all this QT stuff, but then he said it may be coming soon. And that I think also triggered a bit of the reaction in the US bond market and then the dollar. And as you say, the market was positioned too much, far too hawkish again. And we've seen it on both sides, right? We always talk about the pendulum swings here, left, right, and center, and then we come back into the middle. So what happened? Before going into the meeting, can you put up the 2-year? Well, I can do it actually. I'll show it.
Yeah, go on.
You want me to show it?
It's up to you. Well,
yeah, I can do it because I've got these little nice little lines on there which show the what the market is always expecting. And if you look at this, that's what I showed a couple of times. Okay, and you see those green lines here, 3 cuts where the dots are. Okay, that's the 2-year. 3 cuts are where the dots are, and the market moved ahead of the Fed. The market moved clearly into the 2.5 cuts zone only. And what have we seen so often of late is that pendulum that continues to swing. So after Powell yesterday, they all had to revise their opinion, and we're actually wider now again, or lower on the yields than those, so wider than the 3 cuts. I don't think that's actually extremely relevant, but it just shows you how this pendulum is swinging all the time. We did it here, we did it here, we did it here, and it's just a continuous game of rebalancing their books and the expectations. Now we need to wait for data to come again. Are we going to get back to those low 440s? Possible. But if the data are strong, we're probably going to be hovering around these 3 cuts again, because that's basically what Powell told us, right? So where the longer end needed to reprice a bit, and I've highlighted this 435, 440 zone a good few times as well. I know it has an impact across the curve, but this could come into play if Powell goes like, okay, we are going to screw down on what we do in the QT, and there we are going to have to look at what's happening again, 420 for a starter. But I do think that here now we are in this bit of a wave zone around this 420. That it may need to take a move down to 408, 410 or so for the market to have gone sufficiently to the other side. So, and if you look at the dollar move, that's exactly what we've got over the dollar as well. The market went into a positioning for a higher dollar based on those yields. And now the yields come back down, and what happens to the dollar? Well, it goes back down with it, and that's really very simple how the bond market and FX market were linked on that from that side. Shall I keep the screen for a little bit, or give it back to you, and then you come back to me?
No, you can keep it for a little bit. I just wanted to add, this is a perfect example of why I always say into big events like this, you need to know what the market is doing right into the event. You need to know what it's thinking, and that can change a week, 2 weeks beforehand. And it doesn't matter what your opinion is, because the market's going to do what it's going to do. Okay. Actually, the reaction of the market being a bit hawkish was, in my opinion, correct, because the forecast went up. They may have kept 3 cuts in, but the inflation forecast went up. So it did have a slight hawkish tilt to the meeting, because it potentially said that rates are going to be higher for longer. And there was no fixed timeline being put in for cuts to come. So the market's still guessing. So being a bit hawkish, the market was right, but it was wrong in how hawkish it was. So even though the dollar sold off, that was probably an overreaction as well. But here we are, basically, as I said, back to where we started before the data started dropping last week. And now the market's going to play the same game again after the next round of data. And PCE is going to be important next week. I think that could be maybe a trigger for the market to then go a bit dovish and pricing back up for 3 cuts, because if that drops to 2.5% or more next week, the core number, that's going to put them well within target. But yeah, it's just, you've got to know which way the market's leaning going in, because that's your bigger price risk if it's wrong. But anyway, back to UK. Have a look at their gold.
Yeah, no problem. Yeah, I know people look at the metals, right? So we had this really strong bounce now of the 21 and a half area in gold. I think this if you look at it from pure FIB perspective, there's a bit going on here in the 2220s. We are not too far away from it. If ever that the market would decide to continue to go, I think we can go up in the 22 and a halves. It still looks extremely strong, this one, for as long as we stay above 21 and a half, give and take a few bucks, right? So this is what we're looking at right now in gold. Perhaps already, if we see a move back down to that prior high here around 21.93, and that holds, that would be supportive for a move through it. For as long as I said, we hold above 21 and a half, don't really change anything. Even if we get a 50 bucks retracement, it may just be a retracement. Okay. I have a slightly different picture than Stelios on silver, but we are attempting to break here. We are right on it. But I have like 2 trend lines here that are relatively important to me for breaks out of short or more medium-term triangles, and we're right on it. Of course, we are going to have a little bit of resistance around prior highs in the 26s, but if we get a confirmation there, this may be your move that we are Stelios as well and myself are expecting and waiting to happen, and for a push higher here. And let's get back to, oh no, I wanted to show the S&P as well. I know a lot are in this game too. So this is your 2023 move here down, and we are on the approach of the 2.27 level, 52.64. But this is extremely strong, right? So if that would start to break, then I think we can get up to into the 53s. Now, in a bit shorter term, we may look here. We are also running along this along this kind of channel as well, and there also we are not too far. So in the next 15 pips or so, or 15 points, it may be short-term decision time on this one, possible. But here too, similar, for as long as we are above 51.80, I think don't change a winning team. And if we start to get back below 51.40, 51.20, then maybe the picture may change. But for as long as we're above there, this has given no signal for reversing. We are always in this stepping pattern, and the small steps, and then we do another leg higher. So this is really, I would say, still very, very bullish. But okay, we need to respect. Perhaps we are building a bit of a pause here now before doing the next leg higher. Okay, let's look at what happened over the Bank of Japan. And then Ryan put in a very nice post. If you guys want to get back onto our Twitter handle or X handle or so to have a look at it, it's a really nice post around what is potentially going to happen around the 152. Well, again, we failed to get up there, and then we had those articles. We had the dollar turning around, but what are we seeing? We're seeing like a sharpish drop again. All right. And then what happens is we're still above 151, guys. Okay. We are still above 151. And that is due to all those yen crosses. They remain extremely big. Why? Because things that we have been mentioning so often on here as well, that I've been mentioning, when you're long yen, you need to be right relatively quickly. Okay. Because even if they go to 0.25%, and then you get those knee-jerk reactions in the end, but even if they go to 0.25%, you're still going to be ending up with quite a bit of yield differential. So I'd say keep an eye on those crosses, but equally, as we've been saying, listen to what the MOF is saying, because if the rest of the dollars are on the defensive, but those yen crosses continue to go higher on their own, that may raise or a few antennas or make them feel a little bit angry, you know. So if ever we would come close to that, and it would 152 again, I've spoken about 154, 155 as well, if it would break, because that could be like a really fast run. But still, look at the crosses and monitor what's happening in the Tokyo session. They were back today. They have taken it a bit lower to under 150.5, but then around fixing time, I was awake and monitoring it. It did not really go a lot lower. So that means that corporate Japan is not really selling or buying too many yen either. So keep monitoring those, because we are in the end of the fiscal year. In Japan, keep monitoring what's happening in the Tokyo sessions, okay? Especially in the week and a half going forward. That is going to be well, directing what we do in the rest of the sessions. I trust. Okay, so for now we are back above 151. Why? Because probably corporate Japan didn't really hammer it a lot lower in line with the rest of the dollars. It's around 150.5, I think, give and take the first level on the downside, and then we're talking about 149s here. Okay. Now, need to talk about that Swiss, right? Because the SMB gave us what we wanted. Euro Swiss through the zone here, 96 3/4 figure. We are through the zone now. We are holding above. We're trading 97.5. There's a bit of there's 61.8 here of the whole of 2023, which comes in at 94 3/4, which was a bit of a resistance so far. And then the next one is at 98. But I think being through here, 96 3/4 around should already start to show up as a support if this Swiss move is to continue. Globally on the Swiss, I think that the market was sort of positioned for this to happen. I know retail traders were apparently not, but but we are retail traders. We were, but I think it can continue further, because Jordan is not standing in the way of the move. But we may need this market to let work the market a little bit. Okay. So sorry, guys. To let the market work on do its thing a little bit. So we may find a bit of resistance here and do a bit of a sideways for a while, and then see if we're starting to find bids again on various levels. Similar thing on the sterling Swiss. And Fred, or FT in our room, I borrowed your little box here, okay, in the sterling Swiss. Okay, we ran into the 114s, which was my expectation. I did take, I had it on the cut. I did take a fair bit of my ads on because we are ahead of the Bank of England, and not too sure, but the market seems to want to trade ahead of the Bank of England a little bit on the dovish side. And I'll give the Bank of England back to you, Ryan, in a couple of minutes, because I want to hear your thoughts as well.
Yeah, no worries.
But if we get a neutral, and I think neutral will be sort of okay for the Bank of England now. If we don't get an overly bearish or dovish Bank of England, I think sterling should still just hold up and be neutral. We see that euro sterling is hanging around 85.5 without going anywhere. But keep an eye on what's happening here, guys. In the 114s up to 114.40-ish. That's a good close to monitor. If we're above there, then just don't change the winning team and continue to go higher. But I do think there may be on if the Bank of England shows a little bit less of hawkishness, I do think there is a bit of a possibility that this thing comes all the way back down to the support of the channels. Okay, somewhere around the high 112s, and there I look to. Depending on the Bank of England, there I would look to add again to what I'm having now, because I do think still that Swiss franc is going to remain under the cush. Where can we end up? Well, this zone here, anywhere between 115 and 116, I think it's plausible. Okay. Dollar Swiss, I went flat today, even though we broke above, just because I don't know what's going to happen with the dollar. Monitor what the close will be, and even into the end of the week. We are Thursday, into the end of the week, Friday. Monitor where we are on dollar Swiss. It's supposed to be a really good break, but again, I'm not overly sure on the dollar right here right now. So I'm keeping my crosses against the Swiss, and I took that's been running for for 3 months now. Those options I've taken them off today, taken the profit, good enough, job done on this one, and now we see if I need to get back into cash also at one stage. But there is a bit of a possibility that if the dollar continues to weaken, this is going to trade a bit more sideways. So I decided to take the dough over there, and I give it back over to you for the Bank of England, Ryan.
Thank you very much, mate. Great stuff as always. Right, let me grab the screen back quickly.
And while you're taking the screen,
yeah,
don't forget, guys, today as well we have Mexican Central Bank out, and they are expected to cut by 25 BPs. Okay, that would be the first cut that they've done since they started the hiking cycle. So watch. Especially because I don't think that 25 BPs is going to change a lot, because the rest of the LATAM central banks are already in a cutting cycle, Brazil and others. But we have to look. They are also looking at what's happening in the States. The inflation has come down a bit. What's going to be important is what they say in the statement. Are they at the start of the cutting cycle, or is this just a little bit of a give back? And are they willing then to wait until the Fed is moving? Okay, so it's going to be more about the statement than 25 BPs cut, unless, of course, they come just like the S&P and surprises, and they would cut by 50 BPs. Then in that case, I see a good case for the Mexican peso to weaken a little bit. Otherwise, if it's just a 25 BPs and done for now, I think it's going to be a temporary blip in the mix, perhaps. Okay, over to you, Ryan.
Thanks, mate. I hadn't even looked at dollar mex. That was one I was getting a bit interested in down here. I didn't do it because it looked a bit weak, but I've actually gone and I've bought a little bit now just to see what happens. We're back down at this area. So just while you're talking, I bought a bit at 16.71, and we'll see what happens with that. But yes, over to the Bank of England. Now, it's just so you know, there's no press conference, no Bailey waffling, though he will pop up, no doubt, later on the wireless and TV and wherever to explain things away. But there's no press conference, so it's just be the statement. As always, the vote numbers are going to matter, and just looking around, there's a bit of uncertainty over those. These numbers here, I believe, are taken from Reuters, and they're looking for an 8-1 vote pattern. So 8 voting for unchanged, the lone dove, Dingra continuing to vote for cuts. That will mean that the 2 hawks have shifted over to neutral. Other places, other sources have it more split. They have it as 1-1-7 in terms of only 1 hiker moving over to neutral and no unchanged. So I think it's varying degrees, and I've just put a little note in our chat room as well what I think about the vote numbers and how they're going to come in. If it comes in the same as last month, that will be very non-dovish, okay, because there's no indication that we're going to get any switches or the hawks are throwing in the towel or no one else is moving to the dove column. If one of the hikers move over, that's a little less non-dovish, okay, so we're shifting very slightly towards the dovish side. Both moving over is even more non-dovish, but we're not quite at getting dovish, if you know what I mean. So that would confirm the 8-1. If anyone else moves to the cut column, that will be a dovish slant. So that's the way to look at it in terms of the scale. These votes, while they're quite interesting and quite helpful, they can be a bit of a mess sometimes. So you've got to look at those, and then also what the news is in the statement. So how they see things, how, you know, talking about timings and things like that, that will come afterwards. But the initial is going to be a flood, so we're going to have to pick through it. But the market will move on the votes and then move on the details. So just be a bit careful for this one. Trading wise, I'm going to be looking at euro sterling. You know, I was thinking this might be a deciding moment for this 85 level, but here we are again, 50 pips away. I can't see anything big coming that's going to crunch the level here, unless they, you know, maybe have a bit of a hawkish slant to things, you know, and really say that higher for longer is going to be pushed out. The market is still pricing August as the first cut date, but if those, you know, if Bailey is a little bit higher for longer, then the market's probably going to trade around that and maybe even push expectations further out. So I think this 85 should be solid enough on any really non-dovish or hawkish news, but we wait to be seen. I don't see any reason why it should crack. On the flip side, if we see something moving more towards the dovish side, then maybe we get a move up at least to 85.70s, maybe even a poke up to 86s. But again, I don't see anything coming that would suggest the pound will get sold off significantly. So probably we're just going to walk within the range. But
isn't that a bit of the risk, Ryan, that the hidden dove in Bailey comes out? I think that's the risk for the pound. My base case is for a very neutral meeting, actually. But I see somewhere a little bit of a risk that Bailey may slip a bit more into the dovish side. Isn't what do you think about it?
Yeah, it's always possible with him. Obviously, we had that inflation data this week, which was much weaker than expected. So I expect them to pay a bit of lip service to that as well. But then we are seeing these green shoots in the economy. So, you know, they might be thinking, okay, we've seen a little bit of a come off in inflation. It's going to come down more probably in April when the price cap, energy price cap comes down. So, yeah, they're getting into a position where they will be able to cut. That may come more to the fore. But on the flip side, on the other side, the economies might start picking up. Wages are still high. And there's still inflationary pressures in the pipeline underneath, like we saw in today's PMIs. But yeah, I think it's going to be a bit Powell-like, but without the heavy expectations going in. It's probably going to be, we're not much change from the last meeting, irrespective of the data. We're going to continue as we are, and when we feel it's right to cut, we're going to start cutting. But again, with this vote situation, that could change upset the apple cart a bit if there's a big change in there. So yeah, it's all to play for. But either way, even if Bailey's a bit dovish, I don't really expect the pound to go anywhere massive or break any ranges. I don't think cable will be at 130 or 125 after this. That's my base case.
No. But I think the market is a bit preparing a possible slightly dovish one, because euro sterling was trading 20 pips lower an hour or two ago, and I guess some longs in sterling perhaps getting out a bit in just trying to prepare a bit of a risk, but we will see. I'm base case to me is neutral anyway. So.
Yeah, because it was going the way, because obviously that Eurozone data wasn't the greatest, and the UK data was a bit better. So obviously the pound gained on that because it's opening up that economic activity gap potentially between the two countries or areas. But like you say, yes, it's bounced back with the pound getting sold off. But we've come through BOEs, we've come through ECBs, we've come through all of it, several times over. And look, we're still here. We're not bouncing. I think that's the more significant thing to look at. We're not bouncing off this level, but neither are we breaking it.
Yeah.
So at some point,
I agree with you. I mean, if they're neutral to even a slightly hawkish, I think that we may be in for a retest of the 85 to 50.
Yeah, but I would think it would probably hold if I'd gone to my head.
It's no use to try and hit it before it actually breaks.
No, exactly. I'll be less keen on a stop reverse, if we get down there over the Bank of England, because I think it would just be a reaction, and maybe someone will try and trip some stops and get something going, and then if that fails or if that happens, then it will get bid back up again. So.
And your euro sterling votes are not calling for a break either. There is a
I'm not even going to look. And euro dollar as well, under 5%, 4.91.
Euro sterling is at 365.
Is what?
Yeah, euro sterling is at 365. We're going to find plenty of people on both ends of the ranges again, I guess.
Yeah, exactly. Not that it's a volatile currency. I don't think I've ever seen it at 6% or anything like that. But yeah. It is what it is. So that's my thoughts for the Bank of England. Kay, you've got yours as well. So yeah, I think we're done. We're done. One more day to go. I'll tell you what, I'm putting my feet up tomorrow. It's been a long old week this week. So there we are. We've got through the Fed. We've got through everything else. A couple more to go, and then we can all put our feet up. Yeah, let's all have a long weekend. Drinks are on K-Man after his Swissy trades.
And on your S&P.
Oh yeah, on the S&P. Yeah, that's actually one. Just quickly, here's one trade that is easily explained. Okay, the market wasn't hawkish or dovish for stocks. It didn't get anything hawkish from Powell. That was its risk, and boom, we're off again. And I was mentioning trying to make these highs. They've got to hold them. We haven't. We're off and running again. Now I've got to do all my drawings up here like I was doing down here and everywhere. So onwards and upwards it goes. I'll keep slicing until I run out of slices, and I'll get stopped on my trailer. So yeah, we'll both get the beers in this weekend, mate. We'll both get the beers in. Right. Have a good one, everybody.
Thanks, Ryan.
Trade safe. See you tomorrow. Thanks a lot.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.